Expert tips for beginner investors. The best path forward for new investors is one that includes a sharp plan to maximize their stock and fund picking experience. Market experts advise taking these tips to the table when formulating that plan. Spread the wealth. Stashing all your investment cash in one basket can be risky. Your new portfolio is in big trouble if its lone stock doesn't deliver or collapses entirely. That's where portfolio diversification can help. Diversification is a technique of investing in different asset classes, such as technology, energy, oil, or Fortune 500 companies, to spread out the risk of a potential downtrend in one or two areas of the market, said Chris Whipple, partner and financial advisor at Christopher Curtis Financial in Nashville, Tennessee. This allows your portfolio to have a balanced approach versus putting all your chips on red. It's okay to think small. Many aspiring investors have trouble getting started at all because they feel like they can't afford to invest a significant sum of money. That's not the case. It doesn't feel like it's worth the effort, but saving $50 or $100 every month without fail can be a big difference maker, said Matt Hyland, a financial planner at Arnold & Moat Wealth Management in Cedar Rapids, Iowa. That's especially the case for young investors who have potentially decades of growth ahead. In that scenario, compounding interest will grow even modest amounts of money significantly over time. Let's say a beginning investor saves $100 per month for 40 years with a growth rate of 8% annually. That sum will grow to about $310,000. But saving that same amount for only 38 years will result in your final total being just about $264,000, Hyland noted. Those 2 years of added savings of just $100 per month result in nearly $50,000 more at retirement. So don't be afraid to start today, even with a small amount of money. Build an emergency fund. Having a financial cushion when starting out as an investor is no luxury. It's a necessity. That's why it's vital to build a household emergency fund to fall back on if things go awry in the financial markets. Aim for 3 to 6 months of living expenses, and be careful where you safeguard the money. Emergency fund cash should be held in a high-yield savings or money market, said Trevor Mann, an investment advisor at Consolidated Planning in Glen Allen, Virginia. With an emergency fund, you're diffusing the underlying risk here of being forced to sell your stock market positions at inopportune times in case you need the cash for an emergency or opportunity. Think long-term. One big error new investors make is trying to time the market versus prioritizing time in the market. Beginner investors often try to overanalyze the market in short-term time horizons and select when to enter and exit their investments, Mann said. This is because roughly only 8 of the best trading days in the market result in 90% of an average stock index's return for the year. A more resilient investment behavior is dollar-cost averaging into the market each month. That means investing a fixed dollar amount every month, or every week, if you can swing it, no matter the share price. Doing so builds regular investment discipline and allows you to take advantage of compound interest over a long period. Follow 5 fundamental investment principles. Way too many people mistakenly think that being a successful investor is simply about buying low and selling high, said Lynette Khalfani-Cox, a personal finance expert and author of Bounce Back, The Ultimate Guide to Financial Resilience. In reality, there are 5 phases to the investing process. According to Khalfani-Cox, these fundamental investment tenets include strategizing to buy suitable investments that fit your goals, risk tolerance, and time horizon. Buying the right mix of stocks, bonds, mutual funds, or other assets. Holding, monitoring the assets you own to make sure nothing gets out of balance and to avoid duplicating investments. Selling various investments at the right time, for the right reason, and in a tax-efficient way. Dealing with financial intermediaries, such as stockbrokers, investment advisors, or money managers, so you get competent, quality advice. If you fail to consider any of these 5 parts of the investment phases, you can get burned in the financial markets.